Welcome to everybody. Thank you for coming. My name is Chris Paxson. I'm here at the Woodrow Wilson School. And I'd like to welcome you especially because this is the first of 6 lectures sponsored by the Woodrow Wilson School on financial market regulation. This series was the idea of today's speaker, Jon Corzine, who we are very happy to report will be a visiting professor at the Woodrow Wilson School for this entire year.
Thank you, better. Thank you.
Is that better? I always forget. It's too low for me. So, few people can claim as many titles as Jon Corzine. I've been told that he can take the title CEO, Senator, Governor, Sergeant, and high school quarterback, although he just told me he was actually a better basketball player. So he's done a number of things, very important things. He served as New Jersey's governor from 2006 to 2010, and one of its senators from 2001 until 2006. While governor, Corzine served as ex officio member of Princeton's Board of Trustees, a position held by each sitting governor of New Jersey. Prior to his time in public office, Governor Corzine was chairman and CEO of Goldman Sachs, where he oversaw the conversion of the investment firm from a private partnership to a publicly traded corporation. He also served under President Bill Clinton as chairman of a presidential commission studying ways to increase federal investment in schools, infrastructure, and technology. Governor Corzine now serves as chairman and CEO of MF Global, an international broker and intermediary firm offering solutions to global cash derivatives and related markets. Today's talk is titled, After the Crash, Regulating the New American Economy. We encourage you to attend the other 5 talks on this topic, which will feature speakers such as Henry Paulson, Josh Bolton, Gillian Tett, Roger Lowenstein, Andrew Ross Sorkin, and Gary Gensler. The series will conclude with a talk by Paul Volcker. As you know, all of our 4:30 events are open to the public, and to find out about the schedule, you can sign up for our weekly events e-newsletter for a complete listing, and there's a sign-up sheet near the door. So please help me, join me in welcoming Jon Corzine.
Very much that kind introduction. I really was a better basketball player. I had much better shooting percentage than I did completion percentage as a quarterback. It is really terrific to be here at the Woodrow Wilson School. I'm honored to have the privilege to both present this colloquium or a series of lectures, which I think people will find very interesting, but also the class that I will teach graduate students mostly in the second semester, which will deal with fiscal policy, which is something that is clearly on people's minds in a very serious way, both at the federal and state level. And it's also a special treat for me to be the John L. Weinberg Goldman Sachs visiting professor. It happens to be serendipitous to this event, but as most of you know, I worked 25 years of my life at Goldman Sachs, the last 5 of which I served as a senior partner. John Weinberg was my boss for all of that period of time, except for the first 20 years, excuse me. And most of that time I directly reported to him. And he was quite a character and quite a man. He had tremendous integrity, and he had a passion for Princeton. Had a passion for the Marine Corps, a lot of things that we had in common. And he is a real honor to serve as a visiting professor under his rubric. I know how much he cared about this university. I'd also say that it's a real pleasure because Woodrow Wilson is a terrific forum for the debate, the discussion, the research, the study of many of the most important public policy issues we face as a nation. And I'm honored that I have a chance to join that process and debate afternoon in the weeks ahead. So the topic, I think, is very timely and important. Our financial system has gone through enormous stress, distress, the traumatic economic experience of the 2008 market crash, but more importantly, the economic events that surrounded it, both preceding and after, I think are really quite important. You don't have to be too much of a rocket scientist to figure out with the peak to trough household loss of $17 trillion, hard to imagine exactly what that is, and with only about 30% of that recovered since the market crash of 2008. That, by the way, includes other household assets like houses and other valuations. It's a tremendous blow to our economy and to the lives of people. More important, almost 17% of Americans today are either unemployed or underemployed. That's 26 million folks that have been impacted in their personal lives directly by the fallout of the challenges that came out of that economic challenge that occurred following and in part of the crash. And there are tens of millions of people outside the United States that suffer from the same events. Poverty levels in the United States today, other than for very short periods of time during the 1982 and 1991 recession, are the highest since the 1960s. And you will all recognize, if you follow latest statistics, the amount of uninsured Americans is up another 4.5 million folks in the last year, as revealed by the Pew Foundation. And as political scientist Jacob Hacker has demonstrated, American families face more economic challenges and volatility, and I'll speak to specific elements of that later in my talk, since the 1930s. And since I'm a recovering politician, I would say that many of us could say that many Americans are only one paycheck away from losing their home, their health insurance, pension, and all of the elements of economic security. It's a tough time. And the effects of the crisis are not just here in the United States, but they are global, both in the developing and developed world. And I'd last just say some of the implications of this. I think many of you probably followed the events at the UN last week. This is the first time in a decade we have not seen declining extreme poverty in the developing world. It dropped from 1981 to 2005 from 52% of the global population to about 26%. We've seen that actually be slightly reversed since the period of 2008, according to the World Bank. By the way, extreme poverty is measured at earning $1.50 a day or less. So while there was real progress made in recent years, some of that has been reversed as well. In short, whether you want to measure it in dollars and cents, or whether you want to talk about it in human terms, getting our economic structure and financial policies and economic policies correct is a major ingredient in making the world a better place. And one of the things that I want to emphasize in today's talk, I'll say it again as I conclude, is get a little bit upset personally when I hear people say that the cost of regulation and the cost of involvement of government is very, very high when it is not put in conjunction with the kind of costs that I just talked about. These are more spread out. A lot of them are not seen, but they're just as painful as a slightly lower rate of return on capital at MF Global or Goldman Sachs or other places. So I think that has to be considered. Our incentive to avoid a repeat of this crisis, I think, is also pretty self-evident from the kind of numbers I talked, and certainly could take other places. And so that's why this series of discussions and lectures and the debates that go on in Woodrow Wilson School are so important, because getting this right makes a real difference in people's lives. As I said, I'm a recovering politician. I am an aspiring banker, maybe even a recidivist banker of sorts. Some people would say I'm a two-time offender. I would say, though, that I want to be clear, I have biases that build up from the experiences of life, both in finance and public office, that some of my remarks will be colored to. Compensating for that possibility, I hope that as I go through the agenda, you'll see that I'm trying to bring different points of view, not just people who agree with me, to discuss the issues of how our economic system, our financial system should be reformed. At the center of this debate, we want to make sure that we also look to what has already been put on the table by the Congress and President Obama, the so-called Dodd-Frank bill, which I'll make some comments on at the conclusion of my remarks today. On balance, I happen to think they were more good than bad, but I think it's important that we consider that, and also the unfolding of other elements of reform that are happening across the globe, Basel III in particular being one of the things that we'll comment on. Now, as a last note of introduction, let me thank all of you for being here. I appreciate very much people coming out. I have to say it's a slightly different audience, slightly different forum than what I was standing before a year ago at this time. Matter of fact, it's a hell of a lot more comfortable. Running for re-election in the midst of a recession had its challenges. And one of my mentors, Brendan Burke, some of the folks that are in the media have heard different shapes and forms of this, but he warned me when I started running for re-election that I had to get prepared for a little angst and agita out on the campaign trail, and I was likely to be greeted with the proverbial one-finger wave. Guess what? He was right. And to say that at least 2009 was tough, I think a lot of folks are finding that out on both sides of the aisle in 2010 as well. Recession, sluggish economic growth, it's a pretty toxic combination for a lot of the conversations that we're having in the political square today, and I think makes for a very difficult time to have the discussion on complex issues like we will bring up today and bring forward today. And it is even more important that in our academic institutions across the country that we're working to have those policy debates so that when the heat is off, you actually can get back to reasoned, researched responses. And so I'm pleased to be here. And so, as I said, I'm honored. And I do want to say, I'm pretty happy. Most of you waved at me with all 5 fingers, so it's a good place to start. So let's go to the causes and cures of the economic crisis, which is the heart and what we will be discussing over the first session here today. And then the second session in the series will deal with some of the specifics, particularly the growth of new financial instruments, derivative instruments, extreme buildup of leverage, the development of shadow banking, and as Dean pointed out, Gillian Tett from the North American editor of the Financial Times, and Roger Lowenstein, who has commented on financial affairs for a better part of 20 years and is the author of the best-selling book, The End of Wall Street, will be here 2 weeks from now. The third session will be Hank Paulson and his perspectives both on how you deal with the moral hazard of too big to fail and the circumstances that surrounded the heat of the crisis that occurred almost 2 years ago to this time frame. It should be a very interesting session. The fourth will be on the topic of Wall Street's compensation and the asymmetrical incentives that may be built into that and the changes that we should look forward to. And trying very hard to twist Ken Weinberg's arm, but if he is not here, we will have as his backup his Deputy Payzar, Professor Bob Jackson from NYU Law School, and Yvonne Chen, who is a leading consultant on pay for many Wall Street firms. Fifth session will be led by a practitioner in the real world today, the implementer of Dodd-Frank, that will be the chair of the CFTC, Gary Gensler, and he'll be joined by another journalist who has strong views and comments pretty regularly, and has probably written the most famous book, Too Big to Fail, with regard to the 2008 crisis, and that's Andrew Ross Sorkin from the New York Times. And the last session will be led by former chairman of the Federal Reserve and economic advisor to President Obama, Paul Volcker, Princeton's own, and frankly, Paul Volcker can talk about any damn thing he wants to, and probably will. He is not a guy that you can coach into boxes on these issues, but no one has a better perspective on how we got here, what we ought to think about doing, and maybe even talking about the future. He has a storied career. As I said to start, I think the need to fix the system is pretty self-evident, and hopefully we'll have good discussions about that. That said, I would argue that the causes of the crash, the Great Recession, if you will, that has followed, the worst and the deepest since the Great Depression, go a lot deeper than simply the issues of our structure, of our financial system. And accordingly, I think if we fail to recognize that, then I think we're almost certain to revisit the problems that we have seen. It's just a matter of when, not whether. And I think it is in this context that I want to make most of my remarks today before I talk about a little bit of the specifics, particularly of the Dodd-Frank reform. The financial system is a mechanism, it is a conduit, it is a vehicle that allows savers to be connected with investors. It's not reflective per se of the underlying economy, it is how we piece it together. And the truth is that no matter what the architecture and no matter what the shape of the reform takes place, outside shocks have impact on markets and the economy. There's lots of things that are external to the financial system that are a lot more important than the system itself. I'll give you two examples, and it's not that very hard to imagine how these would impact the world. You know, a war, a major war, has in the past and could in the future impact what is taking place in financial markets and valuations, and whether values are being created or destroyed. The same thing goes with regard to political elections. I only have to think back to the oil embargo that occurred in the 1970s and see what it had to external to the financial system about the impacts. My point is that much of what occurred from my perspective, and I think from anybody that stands back and studies this, are the economic imbalances and things that were causal, external to the financial system. That in no means excuses Wall Street or the system for the excesses that clearly build up whether it was in the housing sector, the securitization markets, the over-leveraged balance sheets of many of the financial institutions, and the shadow banks, the hedge funds, the other elements of the system that or the dysfunctional and asymmetrical compensation system that so many people have been offended by. These are real deals, and they have caused and aggravated problems, but may very well not have been the cause, and that's what I want to emphasize today as I talk about it. And when we take on financial reform, that's good, but we aren't solving the problems, and I think that far too much of the commentary that I see, whether it's on CNBC or in other places, from my perspective, misses the point that the imbalances are still there and they need to be dealt with. And I'll just give you a reason why I think this is important. It's not just the media that makes this mistake. If you read the Dodd-Frank introduction of what the bill was all about, and I want to quote from it, the preamble to the financial reform bill. It says was to create a sound economic foundation for grow jobs, protect consumers, rein in Wall Street and big bonuses, in failed bailouts and too big to fail, prevent another financial crisis. Goes on to say, we want to put a system in place that works for and protects our people and create a sound foundation to grow the economy and create jobs. Well, you know, it's the cure for the world if you read the preamble. And frankly, I think a lot of people began to believe it. It's certainly a worthy objective, but I think it misses the point of some of the things that are imbalances in our economy and is probably not the cure for all our ills. Certainly politically correct, and I think there are a lot of positives in the way I at least look at it, the 800 pages of legislation. And again, colloquium will bring out a lot of those. I will say, as a businessman, as opposed to one of those folks that are on the political stump, I think there are a lot of reasonably framed and well-informed reforms that are part of the system. I'm getting very personally, because I have a fiduciary responsibility, to understand the details of as much as is possible. Remember, there are almost 240 regulatory rulings that have to be laid down. This is an evolving process. It's not something that is in place as it is. But I would say that we're going to end up with a better and more stable system. I wouldn't suspect, if you surveyed all of the CEOs on Wall Street, that you'd come up with quite the same view, but I'm fairly optimistic that if the rulemaking process that goes through the regulatory side is as open as it is intended to be, we will end up with a stronger foundation for recovery and stability and integrity in our financial system than we were before. And I would just point out that history is a guide. Glass-Steagall, the creation of the SEC, and the reforms that followed the Great Depression, or at least the start of the Great Depression, ended up providing tremendous stability to our financial markets and a foundation for growth that really sustained the economy of America and put us into a position to succeed for the better part of 60 to 70 years. So let me retrace back that I believe that we have to reform the underlying imbalances, not unlike what happened in the 1930s, if we're going to ultimately fix our financial system, even though there's some good things in place. And by the way, the speed bumps that a good financial system lay down can certainly slow down some of the processes that would come from weaknesses if we had had a better system in place in 2008, some of the leverage, some of the challenges that are pretty self-evident after the fact would have been slower and maybe not as extreme in how they took place, but they still have the underlying imbalances in place. And I think this is a little like the debate about whether you're treating the symptoms or you're treating the disease. And so most of my remarks today are about trying to treat the disease. I think if we do want to create a sound foundation to grow the economy and create jobs, we better get at those imbalances. And on these issues, I'm going to take some editorial license and admit once again, that I come with at least some experiential biases that are built into how I look at it. You'll probably find some of them a bit surprising. But as a citizen, as a washed-up politician, as a rookie banker, and academic, I'd say our number one issue, and one that I'll speak mostly about today, we've got to recognize and address the staggering redistribution of wealth that is and income that have occurred over the last 40 years in American life. And in my view, have created a pretty toxic sense of inequity and filled our spiraling appetite for debt in our society. And that leads to the second imbalance, which is pretty well accepted by both the right and the left in our society. We need to address the accumulation of debt at every level of our society. Too many individuals and public entities have chosen to borrow for consumption today at the expense of building capacity for the future. And in fact, some would argue this has been probably the largest period in history of wealth transfer. Most folks, as opposed to talking about it in income and wealth distribution terms, would say we've transferred generationally from the future to current consumption. And I think that's something that there's pretty wide agreement on. We've pretty literally been raiding our grandchildren's inheritance, and we have failed to make the kinds of investments in our infrastructure, our educational system, and other aspects of society that would create strength as we go forward. That, I think, lays the preconditions for another round and bout of crash and crisis and cycle. Frankly, on these two topics, unless we change course, I think it's almost inevitable that we will get to revisit the kinds of problems that we saw coming out of the 2008. I do want to say a third broad element which touches on the financial crisis but is equally important is the deterioration of our educational system. I think that's for lack of investment, but I also think it puts us in a very serious compromised position for promoting equality of economic opportunity in society. It also puts us at a horrible global competitive disadvantage and undermines our capacity for innovation. And I can tell you, on a practical level, I see it every day as I'm now trying to build a business across the globe, whether it's in India or China or in Asia, or who we're hiring for the creation of our systems programming and other aspects. It is a real danger that I think our country has to take into account. Being ranked 16th out of 24th developed nations in college graduates just doesn't happen. And it will lead to a further erosion of income equality in the country, and I think aggravate all the other problems that we have in place. Again, all of these topics are big unto themselves. They're really outside of the scope of what we're even trying to talk about here, other than the fact that they really underline the causes of how we got to this stage. And if we forget that, I think we will be very short-sighted, and again, we will revisit. Let let me just say today, I'm going to stress the conversation about income inequality because I think in many ways it is most closely tied to the specifics of what people call the financial crash that occurred in 2008 and the characteristics of that. And I guarantee that the trends that I talked about, both with regard to income inequality and then the stress that our middle class has fallen upon, and the debt crisis itself that is building up, is understood by the financial system and is being addressed in a profit-making motive. People take on the debt in the financial balance sheets of institutions, and they've recognized the vulnerability of the middle and working class Americans to credit and how they have compensated for stagnation of wages. Let me try to get a little more specific there. This is, I think, the heart of the issue. Let me try to give you a narrative. Since the bankers understood that middle class and working class Americans were under pressure, they needed to compensate for it. They did it by borrowing. And many market participants were ready, willing, and able to take advantage of financial illiteracy that I think our educational system does not address adequately, and allow credit users to engage in taking of credit that frankly bordered on, if not was, predatory lending by a lot of those operators in the market. Mortgage originators recognized that many Americans had maxed out on their credit cards and were ready to make the bet that rising housing prices, would allow them to carry adjustable rate mortgages, extract equity, second mortgages from their homes, and maintain the middle class standard of living they had. Other market participants developed techniques to securitize debt in a way that was supposed to spread risk across the board. As a matter of fact, we heard the chairman of the Federal Reserve say that a lot of these techniques of spreading risk gave us greater security. But they really just created new opportunities for additional leverage and repositioning of the risk exposure. And throughout all of this, government wasn't just negligent, in my view, was often complicit. Complicit because it didn't enforce the rules that were in place, and second, it sponsored entities like Fannie Mae, Freddie Mac, Sallie Mae, which helped supercharge the private sector's appetite for extending credit for so-called carry trades that were insured by these institutions. The fuel that really created the balance sheet and the leverage that ended up being such a problem in 2008, mortgages, student loans, and other government-backed guaranteed issuance. Because the underlying credit was government guaranteed, financial institutions build up their positions. Lots of strategies that say, you want to buy this high-grade quality credit, finance it at very low rates, make a profit. Do the same thing with a lot of the derivative transactions that occurred, and the rating agencies were complicit as well as the regulatory agencies in saying this was basically government guaranteed debt and it was fine for people to go on. The narrative begins and ends, however, with a strained American middle class, strained working men and women in the country. Now, I want to take a little more detailed look at this, sort of a little more objective than even the narrative. I think most people recall that for most of the post-World War II period, up until the 1970s, American workers saw their real wage income grow 2 to 3% almost every year. It was an era of suburbanization, growth, widespread union membership, high productivity growth, expanding access to education, and developing international markets. It was a time that a lot of people look back fondly on as maybe the most stable period in American economic life. In 1973, median income had peaked at $45,000 plus, and then it stopped growing from 1973 to almost 1990. In fact, it declined during those years, and until the late 1980s, early 90s, there was, until it returned to modest growth, it really went downhill. Today, median household income stands at just shy of $50,000. It's about 10% higher than in 1973, but essentially flat when you consider the underlying cause of the growth. Keep in mind, per capita wages in that period, as opposed to household, have not gone up. What happened is women went to work. Between 1973 and 2009, the number of women in the workforce grew by 70%. Overall, at that same period, although on a catch-up basis, women's income rose by about 20%, and men's income declined by 9%. So you can see if you had men working almost to full out capacity in the 1970s, real per capita income was under a lot of pressure. And simply put, the only way that a middle-class household was able to keep their heads above water in this period was to move from a single-income home to a dual-income model. And all this was happening while other pressures were occurring at the same time, and people took on second jobs, worked longer hours. Really was a very difficult period for middle-class Americans. Just to give you a personal perspective, when I graduated college in 1969, the poorest quintile of Americans earned 4.1% of the nation's aggregate income. The richest quintile, 43%. Today, the poorest quintile gets 3.4%. Remember, that's 20% of our population. And the top 20% get over 50%, 50.3%. What this means in the relative terms that 17% decline for the poorest 20%, 17% increase in that period for the wealthiest. Even more pointedly, the middle three quintiles, and this is the point that I want to make, saw their share of national income drop from about 53%, 52.9%, down to 46.4%. A relative drop of 12%. That's the middle 60% of income earners in the United States. And in a democracy, as a matter of politics, this trend is at the very least challenging and slightly destabilizing. Some people might want to connect it to some of the things that we now call the Tea Party. As a matter of economics in the United States, it's unsustainable. You don't have to be a Keynesian, you don't have to be a monetarist, you don't have to be a supply-sider. When 70% of GDP is driven by consumption and 60% of the population is seeing their real income shrink, you got a problem. The wealthiest slice of Americans can only buy so many cars, computers, homes. Eventually, the other 80% of the population need to see growing purchasing power if we're to see our economy grow. By the way, the only other time that I could find that looked a little like this was in the 1920s. It's the last period in U.S. history when income and wealth distribution looked like this. Really was this much askew. A lot of historians would argue that the great cause of the Great Depression was, in fact, this income and wealth inequality. In 1929, the richest 5% of the population earned over 1/3 of the country's disposable income. The richest 1% earned 19%. Today, we're almost parallel with those numbers. Almost parallel with those numbers. And just to make this a little more clear, preceding the crash in October 1929, the limited purchase power of the working class had already begun to show up. There was a 33% decline in the 9 months leading up to the crash in automobile sales. We'd already seen a major fall off in consumption that occurred, and that was preceded by residential construction over the previous 2.5, 3 years, decline of almost 20%. Point was, the crash wasn't the cause of the Great Depression, it was a cause. What was true then is equally true now. High concentrations of wealth and income are destabilizing to the macro economy, and the fundamentals of this problem long preceded the crisis of 2008. Keep in mind, by the way, and this is an important part, is some of the most vital elements of consumption of an ordinary middle-class household, healthcare, education, cost of housing, far exceeded any of our standard indices with regard to inflation in this period of time. So the high-cost things that were very much part of people's lives were accelerating the cost. And you add to that then these economic uncertainties, risks, and volatility that have occurred, and they have been building up long before 2008. Personal bankruptcies have quadrupled since 1980 to 2005. Home foreclosures have grown fivefold from the 1970s to 2007. And as recently as 2007, 80 million Americans, including 1 out of every 3 non-senior citizens, went without health insurance over the previous 2-year period. That's a lot of stress to be carried in addition to the economic of flat wages or declining real wages. So how did the middle class make up for this real wage decline, higher prices, and greater volatility? It's really 2 ways. First, as I mentioned, married women went to work. People worked longer hours. They made up for stagnating wages by working more and more of them. And second, Americans stopped saving, and they went deeply into debt. That debt went into the balance sheets, by the way, of financial institutions. Middle class Americans took on credit cards, student loan debt, mortgage debt, and when they couldn't take on any more of the first order instruments of debt, they turned to exotic mortgages and second line liens on their houses, creating the fodder, the fuel for the financial debacle. According to the Federal Reserve, total credit card debt in constant dollars rose by almost tenfold between 1973 and 2008, and there are parallel growth in numbers for mortgage debt. And considered in this context, the appetite for risky adjustable rate mortgages was a natural byproduct of middle-class squeeze. This is a way to hold down the short-run costs of what mortgages would cost to carry. And having maxed out on credit cards, many people made a bet on the rising prices of their homes by extracting equity from their property, home loan, second loans, to try to maintain that middle-class dream. One problem with that, prices don't always go up, trees don't grow to the sky, and when there's a burst in the housing prices, then all of that financial paper that lays on the backs of those that borrowed and on the balance sheets of the banks loses enormous value. Let me be clear of what I'm saying. We can impose tougher regulations on the mortgage and securities markets. That's great. And we're right to do that. But it's not enough without addressing the underlying challenges that exist with regard to income distribution and earnings for our middle class individuals in our society. And the issue is compounded, particularly at the time of recession. The number of people that go into poverty, as I suggested, goes up. The children of poverty parents tend not to complete high school, end up having lower wage earnings as we go forward. And in fact, there are studies around Collins, Cleve, Belfield, and Henry Levin estimated the average high school dropout later cost taxpayers $125,000 over the course of his or her lifetime in public health and criminal justice. It is an extraordinary growing burden both for the public sector as well as in the lives of the individuals. I don't want to conflate these things. Poverty is morally unacceptable, but it is an economic poison pill for our society. And people are moving from the middle class, unfortunately, much more into that, even as the middle class is being squeezed. This cycle is anything but virtuous, and we see the result of this in society. Like a lot of industrialized nations, the United States is experiencing increasing job polarization. That means that the people who have the good education get the good jobs, whether it's in medicine or engineering, finance, or technology, and the only real growth in jobs for that middle sector or low education sector, food preparation, janitorial services, and home health care. There's a tendency for this, and it really needs and cries out for public policy responses. So what are the answers to that? Well, that's, again, another topic that takes up many, many courses. Many on the left believe raising the minimum wage, making more liberal use of the earned income tax credit, a reformed and steeply graduated income tax or tax system more broadly would rebalance wealth and income. A lot of people who make that case will look to the 1990s and look at higher marginal rates for than where they are today, and economic growth was robust and inequality at least flattened out, and some increase in real wages that you would argue that those kinds of policies have merit. On the right, there is a strong belief that the tax code is about using the tax code to redistribute income and wealth is inappropriate and counterintuitive to investment. And so this is a debate that you can hear day in and day out. Any one of your cable television channels if you want to carry it further. But this issue needs to be resolved because the growing inequality, the growing debt need to be addressed, and it's vital that we get to a conclusion on it. I will say there is limited near-term support for the view that lower marginal rates somehow lead to greater investment share. 2001 to 2007, net investment as a share of GDP averaged just 2%, lower than any post-recession cycle since World War II, lower than any. But again, I'm letting my biases show. By the way, productivity didn't grow in that period as well. It's begun to grow in the post-2008 period, but mostly through cost management by corporations and the reduction of people in the workforce. So I think there is a lot to be said on this, but the most important point I want to make, if we don't address the underlying macroeconomic challenges, we don't solve our financial stress for the long term, and we certainly won't create stable growth. All that said, I'd like to say that it's a good thing that we're working on the conduit, and I believe that, frankly, there's been a lot of good work done through Dodd-Frank and is now continuing with the international Basel agreements that are evolving as we sit here today. Let me say I have 4 observations I'd make about financial reform that's taking place. The first is the one that I made earlier. We need it because if you have the kinds of costs that evolved, that $17 trillion shock value number. We can afford a lot of regulation if we avoid that kind of loss of wealth in our society. The second thing I'd say, and I really believe this, there's need to have some study on this and a little more research. I was with a group on a panel here in Princeton on Friday, and I think there was unanimous agreement among 3 economists and 1 business guy that it doesn't matter what the regulation is if you don't have people who are sitting in the chairs of regulators who believe in the responsibility of doing what they have to do, you don't get a good outcome. It matters who actually is the regulator. I happen to be a big fan as a central banker of Alan Greenspan. Alan Greenspan didn't believe in regulation, he would have said so, and both before and is somewhat, he somewhat recognizes as unwillingness to recognize that not everything would be self-correcting in markets. Point being, architecture, details are important. If you have people who don't believe in regulating sitting in those chairs, not much happens because it takes day-to-day efforts. The third point that I'd make is that the Dodd-Frank legislation has many, many good elements in it. We had a system, and I'll try to go through a few of those to identify why and where, and we can talk more about that. We had no system with regard to consumer protection, no systematic view of how we deal with consumer credit in the country. It was fragmented and dispersed across multiple regulators with no real authorities to deal with serious predatory lending elements. The new Consumer Protection Watchdog, Consumer Financial Protection Bureau, you hear Elizabeth Warren set forth, has tremendous examination and enforcement ability for large institutions, and particularly in places where there was no regulation, like mortgage originators, payday loan participants, and in credit rating agencies of individuals, so the reporting, consumer reporting agencies. So there was a need, the coordination and the ability to bring together all those elements into one bureau is an important step forward. And one of the things that's buried in the bill that I think most important is there will be real advocacy for financial literacy in our educational system. Without people understanding what present value is, it's very hard for people to understand what kind of mortgage they're taking on and the leverage they have. So there are many elements inside this bill that are important. I could go on. The second important aspect of the Dodd-Frank reform bill is it is actually coordinating those folks who are responsible for financial stability inside our system. We used to have in our system a very fragmented. FDIC had one set of standards about how they looked at banks. The Federal Reserve had another. The Office of Thrift Supervision, and nobody had the ability to look at the system at large. The new Financial Stability Oversight Council, which is officially chaired by the Secretary of Treasury, but it was really staffed by the Federal Reserve Board, has almost unlimited ability, not unchecked, but unlimited ability to identify financially important institutions, big or small, shadow participants like hedge funds or money market funds or special vehicle in companies set up to do securitization, or banks or securities firms that are not traditionally associated with the Federal Reserve. They have the ability to move where the problems are. Long-term credit, which was a problem in 1999, was known to be an institution that had an extraordinary balance sheet. AIG was known to be excessively levered in the system, but the Federal Reserve and the overall regulatory authorities had no authority to go into institutions and deal with them before there was a crisis. And now, under this new legislation and under this new council, have the ability to do about anything they want to do on examination, enforcement, and bringing people into the system if they think they are a threat to the system. And maybe even more important, the third element is they have the ability to execute the resolution or bankruptcy or elimination of an institution that is failing. Clear legal authority to manage it, not unlike what the FDIC has done with banks for a very long period of time, is to take money out of the shareholders and the creditors before the federal government becomes the lender of last resort in these institutions. That's a good thing. If you come to hear Secretary Paulson speak, you will hear him talk about, I didn't have the resolution authority to deal with Lehman Brothers, I didn't have the resolution authority to deal with AIG, and therefore we had a crisis evolve. We knew it was a crisis, but we couldn't get to the problem. Frankly, that will no longer be an issue and is a major, major step forward. The fourth area of tremendous advance is the centralization and transparency that is coming to a lot of the aspects of the financial market, particularly things that are called derivatives, those things that shadow underlying instruments like stocks, bonds, commodities, and other elements of modern world of finance. To have the transparency of exchange-traded derivatives and what are called clearinghouse mechanisms to make sure that margining requirements are in place for each of those instruments, so that if the price of something goes down, somebody has to have the capital to be able to sustain that position without it being forced into a sale in the marketplace, will take place on a professional and ongoing basis. One of the great issues that if you read Too Big to Fail or most of the stories that are now told about the 2008 crash, Goldman Sachs and AIG had a big argument about what the price of the mortgage securities were that AIG held and how much margin had to be put up. Billions of dollars were at stake. There was no systematic referee to call what that margin requirement should be. Under the Dodd-Frank bill, most of those things that we call derivatives, securitization, one form or another, will go through either exchange-traded facilities, that's where prices are actually reported, just like on the stock exchange or any of your commodity or futures exchanges, but maybe more importantly, they will have clearinghouse mechanisms to say that one party owns the clearinghouse X number of dollars so they can give it to the other party that should be receiving the margin because the prices went up. A major, major structural change, one that is being implemented across the globe and has major impact on creating greater security and stability in our financial markets. It does have one problem. We are taking the too big to fail problem of some of the institutions, the huge concentration of risk is a better way to say it, of some of our largest financial institutions and transferring it now to these clearing houses, the people who are playing the referee about how margin occurs and how prices transpire. And it will require our central authorities, particularly the Financial Oversight Council, a lot of work to make sure that these institutions are properly managed that they have the systems, that they are actually doing what they're claiming they're doing, or otherwise you could end up having transferred the risk that was previously on the balance sheet of an institution into the clearinghouse. But in my view, we are in a much better position under these transparent and working mechanisms to go forward than we would have been otherwise. There are other things in this bill that are very, very important. There are issues about fiduciary responsibility for people who sell securities to investors. There are all kinds of corporate governance rules and changes in rules of governance at the Federal Reserve, all important and positive reforms. But in my view, Consumer Protection Bureau, the Oversight Bureau, and particularly the exchange-traded clearinghouse mechanisms, the fair refereeing, what prices are and how people settle up with each other, are the major, major ingredients of success that I think will be a part of the legacy of Dodd-Frank over a period of time. And Basel III is implementing a lot of these things along with it, particularly leverage rules. That would be in the day of previous eras, financial institutions were considered heavily levered at 15 to 1. That would be their capital is only a 15th of the overall size of their assets and balance sheet. During the 2008 period, the run-up to that, financial institutions were carrying leverage ratios of 30, 35, 40% on balance sheet, and then we're using derivatives off of that. There is the capacity in this Financial Oversight Council and among bank regulators to put much, much stiffer leverage requirements on, and that will also make the system more conservative and I think change the nature and tenor. So I think there are a lot of good things about stability that are built into this, but I don't want us to forget that at the end of the day, this is really about fixing the underlying problems. I think the financial system is a way to spread risk. It's also a way to spread pain. If you don't deal with the underlying causes, you're almost certain to revisit it. I look forward to the discussions we can have in the weeks ahead, and certainly here this afternoon. But on balance, a good start, but we have major, major issues to deal with on these structural imbalances in our economy if we really want to avoid a repeat of the 2007, 8, 9 crisis that has caused so much pain to our citizens. Anyway, I think I'll stop there and take your questions.
Thank you very much. Let me give you the ground rules for questions. We have 2 microphones here. People are welcome to come up. I'd like to ask that students have the chance to come forward first, and if no students come forward first, that's fine. And I'll let you pick your arms, but I'll do them again.
Okay, good.
Hi, thank you very much for coming. My name's Alan. I had a question. I went to Bernanke's talk as well. Can you hear me? And he made an analogy.
On Friday?
Yes. He made an analogy that economic science and economic engineering are 2 kind of separate fields, that economic science is kind of what he is using to undo the damage caused by flawed economic engineering. So I really had a question. If the regulations that are made by government are based on the economic science that is based on the data sets of like financial catastrophe, is that cycle like always going to be such that like financial innovations that are somewhat inherently dangerous and innovative and like unknowable, creating like sometimes catastrophe that only then can we learn about and then only then can we regulate? Like, will that always be the case, or is there some type of regulation scheme that can fix that? Thank you.
Ooh. It's a good question. It's a hard question. It's a long question. First of all, I sort of agree with the chairman in that too much of the blame often is put at the doorstep of economists and economic thought. But I think if you listen to what I was saying, I also think that there were a lot of policy mistakes made with regard to macroeconomic structures, which really gets at the macroeconomic policy. So while I would agree that too much of the blame may be laid at the doorstep of how we think about economic theory, some of that maybe is appropriate since we keep getting it wrong and cycles keep happening. But it's pretty clear that there were mistakes in the mechanism. The engineering is, to use Chairman Bernanke's lexicon. And I think we have done a lot of work to try to get at fixing that. And as I suggested, I think it's actually off on a pretty good track because I don't think it's so heavy-handed that it will keep people from wanting to be entrepreneurs in the financial system. I'm living proof of it. I signed up to this gig after Dodd-Frank, for all practical purposes, was put in place. And in fact, I'm pretty optimistic about the fact that the demand for financial intermediaries will be just as great as it was before the reforms. It's just going to be more spread out and less concentrated among an oligopoly, if you would, of players. And in fact, if they have to de-risk and de-lever the balance sheets of the places that were too big to fail, some of us who were too small for anybody to care about will have a chance to grow into that space. So that's sort of my view is there's plenty of room for entrepreneurial creativity for folks in the new system. And quite frankly, no matter how good or bad you thought the reforms that were laid down in the 1930s were for the system, creativity and innovation moved the system to where it needed reform, and people used, the system's structure to be innovative, and I suspect they will here in this one as well. And as I said, for both of those reasons, I think there's plenty of opportunity for creativity and advancement of the system. What we have to do is have a regulatory engineer's room just as smart as the people who are trying to work the system. If I put it in greater English, simpler English, most folks think bankers do nothing but hire smart lawyers to learn how to circumvent the rules that are laid down. And some of that's true, but some of that's about innovation and trying to get to solutions for clients' problems and the ability to make money. But you have to have smart, thoughtful regulators. That's why you have to have somebody that believes in regulation to make that work. So.
You indicated that the way to deal with the structural inequality is by investing in infrastructure and investing in education. But you have a baby boom that's about to retire, you have healthcare costs that are exploding, and we have a distrust in government that's only gotten worse because of the kinds of bailouts that we saw in the last few years. Do you really think that we're going to make those kinds of investments?
Well, I think infrastructure investments and investments in education, and as I suggested also, reform of our tax system, taking out loopholes and the complications that make people think that our marginal rates are so high when in fact by the time you get done paying taxes, if you're one of the folks that use those smart lawyers, marginal rates aren't nearly as high as they're stated to be. I think if we take on those various issues, we have a good chance of correcting some of the flaws in the macro system. And I think if we were to do that, then there would be a lot more confidence in government. I think actually the tax system is probably more important to be addressed. And by the way, that's the people on the right and the left believe that. Nobody thinks that the tax code, as it now is structured, serves anybody well, and it leads to all kinds of distortions about how people operate. I can tell you that the tax code with regard to estate planning, which I'm now old enough actually to think about, has got so many nuances in it that have people doing so many uneconomic things for the purpose of translating that it would be better just to have a flat rate with no exceptions. And I think if you had that, you'd have a lot more secure system. On the infrastructure and the education, we either fix it or we're going to get our tails beaten in the decades and years ahead. People may not have trust in government, and certainly don't appear to in the debates that both I've participated in and the debates that I now observe as a private citizen. But that doesn't mean that it is an unnecessary reality that we ought to be investing in basic research here at Princeton University or Rutgers, or that we shouldn't be fixing the New Jersey Turnpike or other elements of our infrastructure that create for productivity as we go forward. And in fact, if we don't, and particularly if we don't do that in early childhood education through graduate school, I think we're going to end up losing out to people who are doing that. So we have to restore that trust. Some of that is by dealing with real people's problems, and I think, frankly, I think that probably could be done through the tax system better than most. Sir?
Okay. Well, the rich are getting richer and the poor get poorer, and in the meantime, middle class are hurting too. One of the structural things, it seems to me, is the securities regulations are protecting unsophisticated investors against flim-flam artists, but they're also protecting them against all the good deals, which only go to sophisticated investors. But in the light of that kind of thing, can we really increase the marginal rates on the wealthy in the tax code? I remember in the 50s it went up to, I think it was in the 50s, went up to 91%. And lawyers and accountants just got around all of this. So can we really take any more money from the wealthy, or will they just worm their way around it?
Well, I mean, the simple example is that something worked in the 1990s, and that's a political response, but it's a real response. We created more wealth in that period of time, reduced the deficits, and so marginal rates were higher. You could argue we did a lot better. Matter of fact, in the Reagan years, marginal rates were higher, and my Republican friends would argue that because we reduced them from those high levels that you talked about, you had real stimulus for economic growth. But those rates are a lot higher than where we are today. My point is, I do think there's room for marginal growth. I think far more important is to go back to the beginning and straighten out the tax code. We have used tax expenditures. By the way, I was just as mistaken as other folks, sometimes as a senator, sometimes as governor, because that is about the only way you could get anything done to address a given problem in our democracy. But I think our tax code now is just riddled with expenditures and loopholes, if you will, that make it almost intractable to have an understanding of what marginal rates really are for individuals. And so I would advocate that we need to go back and revisit the Bradley-like reform of the system, then install a a relatively moderately upward sloping progressive income tax system that treats capital and human earnings roughly the same.
I was wondering, do any outcomes of the upcoming elections make you particularly fearful, given some of the proposals that have come out, or extending tax cuts, repealing parts of the stimulus, and any of those strike you as particularly dangerous?
I've said this in public forums. I think we would be well served to leave the tax code alone, both for high income and middle income at this moment in time. I think that there is enough stress in the economy that I would not put additional stress, and so I'd be one of those that would argue for a 1 year or a 2 year extension of all of it, and then step back and have a serious reform at the same time that you put down what would be more sensible, in my view, tax structure that would both generate investment and make increase the confidence of society. It's a lot easier for me to say now that I don't have to work the political field to get the consensus to do that. Yes, there are all kinds of things that could. I think if we let the tax cuts expire right now, we're taking a risk that is way greater than the potential rewards on the fiscal prudence that it would reflect. I think I'm all for fixing our fiscal problems, but I think that needs to come after we get an economy growing again. The economy, if it is not operating at capacity, we will create debt at much faster rates than we will if we extended the tax cuts for a year or two. I don't know whether that addresses your question, but there are lots of ideas that I hear tossed around out in the atmosphere which are not going to happen with the current mix or the post-election mix. But I do think that the sooner you could get on the table the certainty of what will be the tax structure for the next investment period of a year or two, the better we'll be served and the better the economy will be. Sure.
First of all, I'd like to thank you for your service as governor, senator, and CEO of Goldman Sachs, and the work you're doing now.
I was honored to be in public life.
Well, it appears to be at great personal sacrifice. My question is, as we're approaching the world of Future Shock and Brave New World in 1984, we never hear anybody, at least I don't seem to hear other people talking about new and different economic models that will address the family infrastructure, the retirement infrastructure, the productivity infrastructure, the environmental infrastructure, and so on and so forth, in a more holistic view, which countries in Europe seem to be, and maybe Japan, seem to be doing.
Well, democracy is a messy thing. It does not always allow for the kind of holistic thinking that you can lay down when you have very centralized power. Right now you hear a lot of people saying that China may have a better model because they can do all this fundamental planning, but it comes at a very grave cost with regard to personal freedoms. I happen to be one that has more tolerance for government involvement in solving some of the issues of great concern than some others do in society. But I in no way would want to seek the ability to defeat a politician that I felt was taking us in the wrong direction. And that, therefore, creates a very difficult environment for democracies to be clean about setting up those holistic issues. I do think that we've gotten to a point where we recognize we have a fiscal crisis on the horizon, and there is a growing consensus, both left and right, that we have to fix that and or come up with solutions. Whether, when you get to the details and you get away from elections, whether the President's Debt Commission or the Congress can come together on a detailed series of steps, including entitlements, that would be sensible for society. It's tough work. I promise you, someone who tried to take some longer-term views about how you were going to adjust certain aspects of society. You know as well as I do the whole issue of global warming, which there are extraordinary amounts of energy being expended to talk about it in a holistic area, holistic approach, and with a series of responses that are quite broad-based, has a hard time winning the day in a democracy. And so I think we will have fits and starts, and while I don't agree with how it was phrased by our chief of staff to the president, sometimes it takes a crisis to actually get people to act. Certainly people felt like there was a crisis with regard to the architecture of the financial system, and frankly, I think the response has been fairly holistic, and I think is pretty good to the extent that it deals with the architecture, not necessarily the cause of the problems. So I think I think we're destined for that kind of iterative approach to problem solving, and the kind of world that gives us the personal freedoms to say I like you or I don't, and send Corzine back to the private sector.
Well, the only thing I do is those
We only have time for one more very quick question, so I think we should leave it to, Bill, you can probably get up with Nancy next week.
Governor, I think that the difficulties that Elizabeth Warren faced in getting into a position of influence without confirmation seem like a harbinger of problems in implementing Dodd-Frank to come. So I'm wondering what, if anything, you think the Obama administration could be doing better to smooth out that process of implementation and make sure that we still have political will to keep these regulations alive.
I think they need to wait until November 3rd to try to solve out some of those issues. I think that most everything that will transpire between now and November 2nd is all about what happens on those days. Then I think there needs to be a lot of outreach, no matter how the outcome, to bring forward movement on some of the key elements. And a lot of people are complaining about this, the brilliance of Dodd-Frank, because they have set down some extremely important and irrevocable, unless there's legislative action, opportunities for knowledgeable regulators to do what they need to do to set up this architecture on clearinghouses and exchange-traded instruments. They've set up the architecture to create leverage rules and offloading of risk on balance sheets of government-insured depository taking institutions. I think a lot of that stuff is not any longer in the hands of the politicians. As a matter of fact, if I read it right, the lobbyists now are spending no time with the politicians and all the time trying to convince the regulators that they have to take the steps they do. But the more legislation that we could get into the hands of people who have the expertise and less having the rules specifically written by the Congress, I think the better we're served. And if Elizabeth Warren happens to be a lightning rod for controversy, but if she can get this set up, all of the authorities are there, and whoever the person is that then leads it after it's in place, I think can be a very, very wonderful institution and beneficial in dealing with a very laissez-faire system in consumer credit in this country. Okay?
Thank you so much.